Have you ever wondered why smart people still make bad investing decisions? Why someone buys at the top, sells at the bottom, and then says, "I knew it," afterward? Here's the truth. Most investing mistakes aren't caused by lack of information. They're caused by your brain working against you. Today, we're breaking down the psychology of investing, the mental traps that cost people money, and most importantly, how to avoid them. Your brain evolved to keep you alive, not to make you rich. Thousands of years ago, reacting quickly to danger helped humans survive. But in investing, reacting emotionally often leads to panic, bad timing, and losses. Markets reward patience and logic. Your brain prefers comfort, excitement, and certainty. That conflict is where most investors lose money. One, fear and panic selling. Let's start with the most common mistake: fear. When markets fall, your brain interprets it as danger. Your heart rate increases. Your thoughts race. And suddenly selling feels like protecting yourself. But here's the problem. Most people sell after prices have already dropped, locking in losses. Psychology behind it. This is called loss aversion. Losing $100 feels about twice as painful as gaining $100 feels good. How to fight it? Decide before you invest how much risk you can handle. Avoid checking prices constantly. Remember, volatility is normal, not a signal to panic. 2, greed and buying the hype. Fear makes you sell low, greed makes you buy high. When everyone is talking about a stock, crypto, or trend, your brain doesn't want to be left out. You see others making money and think, what if I miss this? That feeling is called FOMO, fear of missing out. Psychology behind it. Humans are social creatures. We assume if everyone is doing something, it must be right. How to fight it? Ask, would I still invest if no one was talking about this? Avoid decisions based on excitement. Remember, popular investments are often already overpriced. Overconfidence bias. Another silent killer, overconfidence. After a few successful trades, people start believing they're naturally good at investing. They take bigger risks. They stop researching. They ignore warning signs. Psychology behind it. Your brain credits wins to skill, but blames losses on bad luck. How to fight it? Track your decisions and results honestly. Assume you can be wrong, because everyone is sometimes. Focus on long-term consistency, not short-term wins. Confirmation bias. Once you believe something, your brain looks for evidence that supports it and ignores everything else. This is confirmation bias. If you like a stock, you'll read positive news, follow people who agree with you, dismiss negative information. Why it's dangerous. You stop seeing risks right when you need to see them most. How to fight it? Actively search for opposing viewpoints. Ask, what could go wrong? Be more skeptical of information that feels comforting. 5, short-term thinking. Your brain loves instant feedback. Markets don't work that way. Checking prices daily makes every small move feel important, even when it isn't. Psychology behind it. This is called recency bias. We give too much importance to recent events. How to fight it? Focus on long-term goals, not daily price changes. Reduce how often you check investments. Think in years, not days. 6, the illusion of control. Many investors believe they can control outcomes through constant action. More trades. More changes. More fixing. But studies consistently show that overtrading leads to worse results, not better. Psychology behind it. Taking action feels productive, even when doing nothing is smarter. How to fight it. Accept that markets are unpredictable. Create a simple plan and stick to it. Remember, patience is a strategy. 7 practical mental rules for smarter investing. Here are simple rules to protect yourself from your own brain. Have a plan before emotions show up. Diversify. Don't bet everything on one idea. Automate when possible to reduce emotional decisions. Learn continuously but act slowly. If an investment keeps you up at night, it's too risky for you. Good investing is often boring, and boring usually wins. The biggest enemy of your money isn't the market. It's not the news. It's not even bad investments. It's you, or more specifically, how your brain is wired. When you understand your psychology, you gain a massive advantage. Not by predicting the market, but by controlling your reactions. If this helped you think differently about investing, consider liking the video. And remember, the best investors aren't the smartest, they're the calmest.